Welcome to the SmartKeys podcast. This is the deep dive. And today we are tackling a topic that's rapidly shifting from an innovation novelty to really a core corporate function. We're talking about strategic digital asset treasury management. So for any company, any asset manager, or DAO, any modern professional holding digital value, this is basically the playbook. It's for establishing defensible, audit-ready operations. We're really looking at how organizations hold, move, and report value using crypto on their balance sheets.
Okay, let's unpack this. We've synthesized a stack of strategic insights, and while the core message is pretty clear,
Right.
if you're using digital assets, the legacy rules of traditional cash management just don't apply anymore.
That's the crucial distinction, yeah.
Yeah.
If we connect this to the bigger picture, traditional treasury, it operates on, business hour batch settlements. It can take days.
Right.
Digital assets operate on continuous venues that settle in minutes. This shift to 247 markets, it forces you to completely redesign your monitoring and your decision flows.
You can't just wait for the next morning. Exactly. You cannot rely on a 9-to-5 escalation process. You need preset limits, fast approvals, and automated controls that can respond to market moves or security events instantly.
And that operational speed is then compounded by this huge shift in security liability. The source material really emphasizes that foundational crypto ethos. Not your keys, not your coins.
Exactly. When you deal with traditional finance, security is delegated. You rely on FDIC or SIPC insurance, right?
Or it's just the bank's whole framework.
The bank's framework. Here, security rests entirely on the company's internal controls. If key material is lost or compromised, that is a balance sheet event, and it's borne entirely by the company.
Wow.
So everything we discuss, from multi-sig architecture to tested recovery drills, immutable logs, it's all about building a control environment so robust that it effectively replaces those traditional third-party safeguards.
So if security is completely dependent on internal controls, where do we even start? The sources make it really clear that the foundation for any defensible program is policy and governance. You need a map before you start traveling.
Policy is the single source of truth. It has to be a board-approved document that defines the entire perimeter. So what assets can be held,
Right.
where transactions can occur, which exchanges or protocols, and who has the authority to initiate or sign off on movements.
And it has to be explicit.
Oh, absolutely. The policy must list permitted assets and venues, but also clearly state all prohibitions, anything that is strictly out of bounds. That clarity prevents mission creep and ensures operations are, repeatable and audit-ready from day one.
But a policy is just words on paper unless it's enforced by some kind of mechanical control. So how do organizations move from that governance document to the actual operational flow?
We synthesize the standard audit principles here. We're talking about aligning to things like COSO principles and SOC reporting structure. The key is preventing concentrated authority.
Okay.
This means mandatory dual control requiring 2 separate individuals, and step-up approvals where higher risk moves trigger a deeper review from a higher authority, maybe the CFO or even a board representative.
That sounds like the classic segregation of duties, but, scaled for 247 speed.
Yeah.
I have to ask, though, for a smaller asset manager or a fintech, how do they practically implement this when they might only have, say, a 4-person treasury team?
That's a great question, and it's where the architecture becomes so critical. Segregation of duties requires the requester, the approver, and the signer to be distinct roles and often distinct people.
Right.
Smaller firms have to rely more heavily on the technology, making sure that access is governed by the principle of least privilege access. So if you only need to confirm a balance, you shouldn't have the permission to sign a transaction.
The system enforces the separation.
The system enforces it, exactly. Even if the same person technically holds multiple roles, their system permissions prevent a self-approved move.
And underpinning all of that technology is the audit trail.
Absolutely. In a world without traditional ledgers, the immutable log is your entire defense. Every single change adjusting limits, adding new counterparties to an allow list, modifying signer rosters, it must be recorded in an immutable log tied definitively to human identities.
Auditors must live and die by those logs.
They do. If you can't log an action immutably, you simply cannot prove the integrity of your controls in an audit, period.
That link between the governance and the architecture, that's where it gets really compelling. Your governance decisions ultimately dictate the tech stack you choose for safekeeping. Let's talk about custody and operational agility.
Well, when we talk custody, there are two primary approaches, and they're often blended. First, you've got qualified custody.
Okay.
This involves a regulated provider holding the assets. They offer clear segregation of client funds, and they provide necessary audit artifacts like SOC reports. This is generally preferred for massive long-term reserves. It gives regulatory comfort, but it sacrifices speed.
And on the other side of that coin, we have self-custody. This is where the company manages everything, right? The key generation, rotation, recovery.
Right, you accept the full responsibility, but you gain total control. And this means you have to strictly adhere to professional key management standards.
And what does that mean in practice?
Well, to manage self-custody responsibly, the source material points directly to professional standards. Things like aligning procedures to NIST SP 857 guidelines for the key life cycle. And regulators often require using hardware security modules, HSMs, that are FIPS 143 validated.
For our listeners who might not be familiar, can you just quickly explain why that specific standard, FIPS 143.3, is so important?
Sure. FIPS 143 is a U.S. government standard for cryptographic modules. It simply means the hardware you use to protect your private keys has been tested and certified against really rigorous security benchmarks. Using FIPS 143 modules just shows a commitment to security that's required for these high-stakes operations.
Given that dichotomy, what are most modern organizations actually doing in the real world?
What most institutions are leaning toward today is really a hybrid approach. They'll use a custodian for the bulk of their large, long-term reserves. That's the cold tier. It's secure but slow.
And then for the day-to-day?
They maintain a tightly controlled warm tier for routine, day-to-day transaction flows. This strategy optimizes for both maximum security and necessary operational speed.
That brings us directly to wallet tiering, which is this strategic model for reducing risk by limiting the blast radius of any potential compromise. You're basically distributing risk across three distinct levels.
Right. The cold vaults are the reserve tier. They're offline, highly restricted. They often require physical presence and multi-person ceremonies just to access the keys. It is the definition of high-friction, high-security.
And the key practical insight here, which I think is often overlooked, is the need for testing.
Absolutely. You must test the access procedure regularly, and not with real funds, but with non-value drills.
So like a fire drill for your money.
Exactly. Imagine a crisis. If your two key signers are unavailable, can the emergency team successfully follow the documented checklist to recover the keys? You need to codify those procedures under pressure, proving you can execute them accurately without the stress of moving millions of dollars.
Okay, so next down are the warm wallets. These are network reachable, but still strictly controlled.
Right. They handle the routine settlements. And warm wallets are managed by layers of policy. They require quorum approvals, say 3 out of 5 signers, and they are restricted to allow lists.
And an allow list just means you can only send funds to pre-approved addresses.
Pre-approved addresses of known counterparties. They also have daily spending caps, which limits the potential loss, and often time locks, meaning a major transaction has to be initiated hours before it can actually be executed. It's security by speed bump.
And again, the practical advice is so critical. Always run a small test transaction before any large move. Make sure the contract and the allow list are working just as you intend.
And finally, you have the hot wallets. These are essential for automated, low-friction operations, but they are the most exposed. They must have strict velocity caps, limiting the amount that can move per hour, and continuous 24/7 monitoring.
What's the most important control there?
The single most important control is the automated sweep, which moves funds back to a warmer tier immediately after a transaction, keeping that operational balance absolutely minimal.
So moving from wallets to the technology, let's compare the foundational control patterns. Multi-sig versus MPC. They both solve the single point of failure problem, but they have different strategic trade-offs.
Right. Multi-signature enforces policy directly at the protocol level. It requires multiple distinct keys to authorize a transaction. Its major strategic benefit is high on-chain transparency. The rules are visible on the blockchain itself, which is often, simple and comforting for auditors.
Whereas MPC, multi-party computation, that splits the key material into multiple shares held by different parties. So it produces a valid signature without ever actually reconstructing a private key in one place.
An MPC often gives you broader platform and chain coverage. It makes it easier for businesses operating across diverse protocols. But the strategic takeaway is critical. Don't just assume one is universally better.
It depends on your situation.
Exactly. The choice depends on your operational needs, the mix of assets and venues you use, and, critically, your auditor's expectation for key recovery and evidence. In either case, having a proven, tested recovery plan is completely non-negotiable.
That focus on auditability and resilience is the perfect pivot into our most complex section. Managing 204/7 risk, compliance in this changing accounting landscape. We established that daily volatility of 10 to 20% is just routine in this market.
Routine, yes, but terrifying to a traditional treasury manager. This demands radically bigger financial buffers than you would typically set aside for fiat operations, and a strong venue diversification strategy to mitigate that counterparty risk.
And the risk has to be managed before the transaction even happens.
Oh, absolutely. You must build sophisticated requests to settle workflows that mandate pre-trade checks. Before an execution order even goes out, the system has to enforce exposure limits, run real-time sanction screening.
Like OFAC checks.
OFAC checks, exactly, and confirm available balances. Skipping any of those steps is an immediate control failure.
So when market stress hits or liquidity just vanishes, organizations have to be prepared to respond without compromising their security. What operational hardening steps are necessary for those high-stress scenarios?
First, you have to run frequent scenario tests, simulate sharp price gaps, liquidity evaporation, exchange withdrawal delays. You need documented playbooks for all of these.
And operationally?
Operationally, you use the things we've talked about: allow lists, time locks, velocity limits. They stop rushed mistakes, which are so common under pressure. And the break glass procedure, your emergency plan, it must still require multiple approvers and produce auditable evidence. Rush security is almost universally poor security.
Can you give us an example of what that break glass process actually entails? It's more than just two signatures, right?
Oh, yeah. It's typically an offline, notarized procedure. So, for instance, the hardware modules needed for a cold vault might be physically stored in a secure location, accessible only by a set of officers acting in person, witnessed by internal compliance, and logged in an external system.
So it's intentionally high friction.
Precisely. The entire flow, physical and digital, is designed to be high friction so that it cannot be exploited for speed.
Speaking of hardening operations, regulatory compliance is always moving, especially for U.S. organizations. What guardrails have to be hardwired into these Treasury flows?
Compliance is a live document. Firms have to continuously document their interpretations by jurisdiction and keep their policies live. The key areas are robust KYC, KYB for counterparty verification, continuous AML and sanction screening, and absolute adherence to the travel rule.
And the travel rule means you have to capture and transmit information about the transaction.
Right. For transfers above specific thresholds, you have to capture, transmit, and retain specific info about the originator and the beneficiary. You need systems capable of retaining this evidence for years on an auditable retention schedule.
Let's wrap up this section with the crucial impact of accounting standards, which have historically treated crypto as a pretty opaque commodity.
That is changing radically. For US GAAP reporting, the game changer is FASB ASU 2023-08. This ruling mandates that certain crypto holdings now require fair value measurement on the balance sheet.
And that's a massive shift.
It's huge because changes in fair value flow directly through to net income. The strategic implication is clear. Your crypto assets now directly expose your P&L to volatility, which makes the 247 risk monitoring and reconciliation we discussed absolutely mandatory, not optional.
That level of volatility must demand incredible precision in tracking.
It does. Operationally, you have to run a detailed subledger with absolute precision. We're talking about lot-level records. This means tracking the specific cost basis, fees, and acquisition date for every single asset you hold.
So if you sell half a Bitcoin, you need to know exactly which lot it came from.
Exactly, to calculate the realized gain or loss accurately for tax and for income reporting purposes.
And how does that detailed subledger feed into the reconciliation process?
It requires a meticulous three-way reconciliation. You're tying out three distinct data points: the actual on-chain transaction data, the third-party custodian or exchange statements, and your internal general ledger.
In any break.
Any break in that reconciliation, any mismatch, has to be logged, root-caused, and fixed to demonstrate completeness and accuracy to your auditors. This is a very manual-heavy process until the automation is perfected.
So what does this all mean for someone listening, looking to implement this? This sounds less like an operational tweak and more like a total redesign of their financial infrastructure. What's the pragmatic roadmap?
You're right. It's a multi-year journey, not a quick fix. We can break it down into a 5-phase roadmap, and it's designed specifically to ensure controls are proven and tested before you scale up your assets or volume.
And phase one starts right where we began. Policy first.
That's the strategic phase. Get that board-approved document defining your objectives, your assets, venues, and approvals. Crucially, the policy must match the firm's strategic risk tolerance and its regulatory exposure.
Phase 2, architecture selection.
Choose your specific custody model qualified, self-custody, or hybrid, and select your control pattern, whether it's MPC or multi-sig. Map out your signer independence and your backup plans. This phase involves a lot of vendor selection and integration planning.
And phase 3 is proving the concept. This sounds like the hardest part.
It is, because you have to pilot low-risk flows to prove the entire loop. Approve, sign, settle, reconcile, report. You can't just assume the system works. You have to measure execution quality, approval timelines, the reliability of your three-way reconciliation.
And if that test fails?
If phase 3 fails the reconciliation test, you stop and you redesign the controls.
Okay, then phase 4, scaling.
You only scale volume and add new asset classes when the controls pass, when reconciliations are reliable, and when your treasury team is fully trained. This is where you go out and secure those external SOC or ISO attestations to demonstrate external validation of your internal controls.
And the final phase, which you mentioned earlier, it never really stops.
Phase 5, continuous resilience building. Run recovery drills, vendor failovers, and tabletop exercises constantly. Every single operational learning has to be immediately codified into updated procedures and training. Expect this process to take, say, 12 to 18 months to achieve true operational maturity with ongoing refinement forever. The continuous operational hardening of crypto treasury is what ultimately yields that strategic advantage. It succeeds only when governance, custody architecture, and daily ops form a single auditable loop. The benefit isn't just surviving volatility. It's gaining the capacity to innovate and transact with confidence because you have proven controls.
And that capability gap is what separates the prepared from the exposed.
That's it. It's what separates the prepared professionals from the exposed.
That is deeply insightful. Building the loop and continually testing its weakest links really is the essence of digital treasury management.
Exactly.
Thank you for tuning in to this deep dive into strategic digital asset treasury management. The sources here represent a crucial resource for navigating this new financial frontier.
Thank you for joining us on the SmartKeys podcast. We encourage you to subscribe for more strategic insights on the future of work and business efficiency.
And if you want the complete, comprehensive resource, including all the specific standards like FIPS 140-3, the details on FASB ASU 2023-08, and that detailed 5-phase roadmap, be sure to read the full article. You can find a link to the full article in the show notes.
Until next time, stay well informed and well controlled.